Welcome back to Free Pizza, where we dive deep into the facts behind the stories that shape our world. Today, we're exploring a topic that doesn't get much attention, but is a huge part of the professional sports industry: taxes. More specifically, the complex tax obligations that professional athletes in the U.S. face. Whether they're scoring touchdowns, shooting hoops, or hitting home runs, athletes aren't just battling opponents on the field, they're also dealing with a complicated tax structure that impacts how much of their multi-million-dollar contracts they actually take home. Let's take a closer look at how taxes work for athletes, from the income tax rates they face to the so-called Jock tax, and even how endorsements and bonuses are taxed. Income taxes. The starting point. The first thing to understand is that athletes, like all other U.S. citizens, are subject to federal income taxes. The highest federal tax bracket in the U.S. currently stands at 37%. Many of the highest paid athletes fall into this bracket, meaning 37% of their earnings from salaries and contracts go straight to the IRS. But it doesn't stop there. In addition to federal taxes, athletes also have to pay state income taxes, which can vary significantly depending on where they live and where they play. For example, if an athlete plays for a team in California, they're subject to the state's income tax rate, which is one of the highest in the country, topping out at 13.3%. Compare that to Florida or Texas, where there's no state income tax, and you can see how athletes' take-home pay can vary widely based on their team's location. The Jock tax, paying to play in different states. One of the most unique and often controversial taxes that athletes face is what's known as the Jock tax. This tax requires athletes to pay state income taxes in every state where they play a game, regardless of whether they live there or not. So if an NBA player has games in California, New York, and Illinois during the season, they'll owe income taxes in all three of those states, in addition to their home state. The Jock tax originated after Michael Jordan's Chicago Bulls won the NBA championship in 1991. California, seeking a share of Jordan's earnings, imposed a tax on the income he earned while playing in Los Angeles. Other states quickly followed suit, and now the Jock tax is standard practice across the country. Here's how it works. An athlete's annual salary is divided by the total number of days they work during the year. This includes game days, practice days, and travel days. Then, they pay income taxes on a prorated basis for each day they spend in a particular state. It's a system that can be complicated and expensive, especially for players who travel frequently for games. For example, let's say a player makes $10 million a year and spends 10 days of the season in California. The state of California can tax a portion of that income, about 2.7%, because that's how much of the athlete's work year was spent there. If that player also plays games in New York, they'll owe New York income taxes on the portion of their salary earned while playing there. And the same goes for every other state where they compete. Signing bonuses and taxation. Signing bonuses can be a big part of an athlete's contract, especially in leagues like the NFL or MLB. These bonuses are typically paid up front and are often seen as a way to entice top talent to join a particular team. But what many fans don't realize is that these bonuses are also subject to taxation. In some cases, signing bonuses are taxed differently than regular income. For example, if the bonus is paid out in a lump sum and is not contingent on future performance, it may only be subject to taxes in the athlete's home state, not in every state where they play. However, if the bonus is tied to performance milestones or requires the athlete to be on the team's roster for a certain period of time, then it can be taxed in multiple states, just like regular salary. And then there's the issue of federal tax. Even if a player receives a $20 million signing bonus, they'll still owe up to 37% of that amount to the federal government. So, while the bonus may look impressive on paper, a large portion of it will be gone before the player even gets to spend it. Endorsements and the IRS. Another major source of income for many athletes is endorsements. From shoe deals to car commercials, these partnerships can sometimes earn athletes more than their actual salaries. For instance, LeBron James and Serena Williams are well known for their lucrative endorsement deals, earning millions from brands like Nike, Gatorade, and Beats by Dre. But these deals aren't just free money. They come with their own tax obligations. Endorsement income is generally treated as regular income for tax purposes, meaning it's subject to both federal and state income taxes. However, athletes may also owe taxes in multiple states if the endorsements are tied to appearances or events in different locations. For example, if an athlete films a commercial in California, they may owe state income tax to California on the income earned from that endorsement. International endorsement deals can complicate things further. If an athlete has endorsement deals with companies in foreign countries, they may owe taxes in those countries as well, depending on the tax treaties in place between the U.S. and the foreign nation. Navigating these tax obligations requires athletes to have a team of financial advisors and accountants who specialize in tax law, taxation of prize money, and performance-based incentives. In addition to their salaries and endorsement deals, many athletes earn money from performance-based incentives or prize money. For example, a tennis player may win millions in prize money for winning a tournament, or a football player might receive a bonus for making it to the playoffs. But like everything else, this income is also taxed. Prize money is generally taxed at the same rate as regular income, meaning it's subject to federal and state income taxes. And if the prize is won in a state with an income tax, the athlete will owe state taxes as well. In some cases, athletes may also owe taxes in foreign countries where they've won prize money. For example, Wimbledon prize money is subject to UK taxes, even for American athletes. Performance-based incentives, such as bonuses for making an all-star team or winning a championship, are also subject to taxes. Just like with regular salary and bonuses, these incentives are taxed based on where the athlete earned them, which can create complex tax obligations across multiple states. Deductions and tax write-offs. One silver lining in the complicated tax landscape for athletes is that they can often take advantage of certain tax deductions and write-offs. For example, athletes can deduct the cost of agents' fees, which can be significant, as agents often take between 3% and 10% of an athlete's earnings. Legal fees, financial advisor fees, and even some travel expenses may also be deductible, depending on the athlete's circumstances. Additionally, athletes who make charitable donations can deduct those contributions from their taxable income, just like anyone else. Many athletes set up charitable foundations to give back to their communities, and the money they donate through these foundations can help lower their overall tax liability. However, the Tax Cuts and Jobs Act of 2017 limited the deductibility of certain expenses, particularly for employees. This has impacted athletes who are technically considered employees of their teams, as they can no longer deduct miscellaneous expenses like union dues or unreimbursed travel expenses. Despite this, there are still a range of deductions available that can help athletes reduce their tax burden, retirement plans, and deferred compensation. Finally, athletes also have to think about their future, particularly when it comes to taxes on retirement plans and deferred compensation. Many professional sports leagues offer retirement plans for players, which allow athletes to defer a portion of their salary until after they retire. This can be beneficial from a tax perspective, as athletes may be in a lower tax bracket once they stop playing. Deferred compensation plans allow athletes to spread out their earnings over several years, potentially reducing their tax liability in any given year. However, these plans also come with risks, as athletes are essentially betting that their future tax rate will be lower than it is now. In conclusion, while athletes in the U.S. may earn millions of dollars, they also face some of the most complicated tax structures in the country. From federal and state income taxes to the infamous Jock tax, the financial world of professional athletes is far from simple. Next time you see a multi-million-dollar contract announced, remember that a significant portion of that money is going straight to the taxman. Thanks for tuning in to Free Pizza, where we break down complex topics one slice at a time. See you next time.